Strategies for enhancing focus in investment decisions. Introduction to investment focus. Investment decisions are profoundly influenced by various psychological and behavioral factors, particularly the concept of attention. The attention hypothesis posits that investors are more likely to buy stocks that capture their focus, often leading to a discrepancy between perceived investment value and actual market performance. This notion finds its roots in the work of Merton, who illustrated that investors' limited knowledge of securities can drive down the expected returns on better-known firms. If investors are predominantly aware of a subset of available securities, they are likely to concentrate their investments in these stocks, inadvertently creating an equilibrium where familiarity assumes greater significance than inherent value. This initial focus on familiarity suggests a fundamental behavioral bias. The tendency to overlook lesser-known stocks that may indeed pose a greater return potential, especially for those willing to venture beyond the commonly held choices. Subsequent studies have broadened the understanding of this attention-driven investment behavior. For instance, Lee and Lamont and Frazani demonstrated how significant market events, particularly earnings announcements, attract heightened attention from individual investors. Lee noted an increase in trading volume following earnings surprises, primarily driven by informed reactions from large trades which outnumber smaller, speculative moves. Conversely, Lamont and Frazani found that stocks which are subject to heavy buying due to earnings announcements often see their prices rise significantly, further exacerbating the effects of attentional focus in investment decisions. This relationship illustrates that the flow of capital in the market can be significantly altered by investors' capture of attention, suggesting that a systematic approach to monitoring investor awareness could enhance decision-making horizons. Investors must acknowledge the importance of diversifying attention beyond the most familiar securities to mitigate potential losses from neglecting undervalued opportunities. The phenomenon where retail investors gravitate towards stocks with volatile past performance, as highlighted by Odeen, points to inherent biases that can skew rational decision-making. Thus, recognizing and addressing the underlying psychological effects of attention in investment processes not only can improve individual decision-making but also can lead to more balanced and potentially rewarding investment portfolios. This broader understanding of attention's role serves as a cornerstone for strategies aimed at enhancing focus and overall effectiveness in investment decisions. Common distractions in investment. Investment decision-making is often complicated by numerous distractions that can cloud judgment and lead to suboptimal outcomes. These distractions stem from both psychological biases and environmental factors that shape how investors process information. A notable phenomenon is overconfidence, where investors, particularly young males, tend to overestimate their abilities as traders. This overconfidence can lead to excessive trading activity, as exemplified by the surge of day traders during the late 1990s, which ultimately resulted in many trailing market averages. J. Choi and C. Pritchard, 2003. Furthermore, the cognitive biases of investors can exacerbate these distractions, leading to poor decision-making. For instance, individuals often succumb to the availability heuristic, whereby they give undue weight to recent events or high-visibility risks while neglecting less apparent, but significant, low-probability risks. Equally important is the framing effect, where the presentation of information influences decision-making. Investors may irrationally cling to losing stocks due to a desire to recoup losses, refusing to sell despite evidence that supports such a course of action. This cognitive dissonance can arise when investors rationalize suboptimal decisions to protect their self-esteem, further impairing their ability to learn from past mistakes. With the overwhelming number of investment options available, it becomes challenging for investors to make informed choices. Limited cognitive capacity restricts their ability to evaluate potential investments holistically, leading to reliance on easily accessible or attention-grabbing information. Charles 1979 Yates. 2007. In this context, not only is an investor's focus fragmented, but the very environment in which decisions are made can lead to significant distortions in judgment, influencing the perceived attractiveness of certain stocks. To improve investment outcomes, recognizing these common distractions is crucial. Investors should strive to be aware of their biases and the potential impacts of environmental factors on their decision-making process. By doing so, they can adopt strategies to enhance their focus and make more informed investment choices, ultimately helping to mitigate the negative effects of these distractions. Such awareness and proactive measures can foster a more rational approach to navigating the complex landscape of investment